do that. All right, so we used to just have, this is 11.3 notes. We used to just have owner's capital and owner's drawing. We have this section now, 3,000 stockholders equity. Okay, and what we're doing with this is we need to do a few things with our investors. Okay, the people that invest money, our shareholders, that gave us the capital, the money to help us expand, start, whatever the case may be. Okay, so these are owner equity accounts that are now called stockholders equity accounts as well. Income summary is gonna be involved here. When we pay things out, we'll talk about dividends, retained earnings, and you're gonna have a lot of this you'll see later. Okay, most corporations have stockholders. We talked about that. It's not practical to pay each stockholder, or put every stockholder's name in our accounts, right? People buy and sell stock, changes their hands every second. So that's not how we're gonna do it. We will record all the stock into capital stock. Now, again, there's a variety of different types of stock. There's preferred stock. There's a ton of different other ways. Okay, so we're just starting out. All right. A single owner's equity account called capital stock is used for all investment of our owners. Okay, so the capital stock, the amount of shares that we have that we've allowed investors to help in our company are going to be listed under capital stock because it's not feasible, all right, to do it a different way. The amount earned by a corporation but hasn't been distributed to the rest of the stockholders is called retained earnings. Okay, retained earnings is stockholders' equity account used to record the corporation's earnings. Anytime we have a net increase or a net income, that increases our stockholders' equity. Okay, it says some may be retained for the corporation for business expansion. That's the retained earnings. So when we finish our fiscal period, we will do those financial statements that you guys did in chapter 8. Okay, now we're going to find net income. And we'll have, when we close it, we'll put some money, and this money will go into what's called retained earnings. And you'll transfer, and you might have a balance in retained earnings. And the idea behind it is you can use the retained earning monies to buy new computers or to, hey, we need a new delivery van or whatever the case may be. And then you can also, and depending on your schedule, the board of directors and all these, your dividend schedule, you might pay it out quarterly. Or they might just every now and then, they got bylaws and they'll set it all up. But we need to figure out when net income increases, that increases our stockholders' equity because it positively affects our retained earnings. Okay. Dividends, on the other hand, these are good things. Dividend is a new account, right? Dividends is what we pay those stockholders. Okay. So we say we can't put everybody's name in here for the capital stock because it's not practical. But these people in capital stock, when we get enough retained earnings based on what the board of directors that they decide, occasionally they will pay out what's called dividends. Okay, earnings distributed to stockholders are called dividends. Dividends, a corporate dividend is this debit increase. Okay, and dividend would be a temporary account. Okay, and that would be similar to drawing. And what dividends does is it lowers your retained earnings. So if your company had $50,000 going in retained earnings going into this year, they made another 75. So now they put this in the retained earnings. They have 125,000 in there. If they pay 50,000 worth of dividends, that lowers that retained earnings, right? That 50,000 in dividends goes one place, retained earnings it gets lowered. So it's like drawing, which it has a debit balance, but it decreases stockholders' equity. Okay. Each time a dividend is declared, the stockholders' equity account dividends is debited. Okay. Dividends is then closed into retained earnings, so we lower retained earnings. Kind of sort of makes sense. Okay. All our shareholders is going to be put into one place, capital stock. Retained earnings is where we put all the money that we make that we haven't sent out to our shareholders. We also can use it for expansions and upgrades. When we pay a dividend, we will debit it out of our retained earnings. We'll close in retained earnings so that we can show that retained earnings is increased with the net income. When we pay dividends, we will lower retained earnings, but it's still a good thing. It gives our investors something to look forward to. Okay. Financial literacy, we can skip. All right, declaring a dividend. So how do we go about doing this? Well, first we got to learn about it a little bit. The board of directors, these people are elected or appointed or, on this board. It's a group of people that make decisions for the company based on the company. Okay. Dividends can be distributed to stockholders only, by a formal action of this board of directors, this group of people that are governing the corporation. All right. The corporation's board of directors could be the owner, the CEO, and the CFO. It could be just 3 people. If it's a small corporation of 15, it doesn't have to be everybody. Okay. Action by the board of directors to distribute corporate earnings to stockholders is called declaring a dividend. So how do you declare a dividend? The board's got to approve it. Then once they decide on it, they will declare a dividend. Dividends are normally declared one date and paid on a later date. That might possibly should be highlighted in pink, because there's going to be a true false question in study guide for sure something that'll say, when you declare a dividend, you pay it that day, true or false? False. You declare it one day, pay it a different day. Okay. When dividends are declared, the corporation is obligated to pay, but not all corporations have to declare dividends. Okay, you don't have to declare dividends every time. Just depends how it affects your stockholders and things. Okay, dividend is a liability, but is recorded like we talked about into retained earnings. It's like a debit. It's like a drawing account. It's increased with the debit, and it lowers your capital. It lowers your retained earnings. Okay. A dividend cannot exceed the balance of retained earnings. That should make sense. If you have $100,000 retained earnings, you want to pay some dividends out, they can't exceed the money in that account. Obviously, doesn't make sense. So they say that the board of directors for 3 Green declares a dividend every 3 months. The stockholders consider some of their earnings. The dividends are paid to them on the 15th of the month following the declaration. Some companies are different. They might say, once you make it big, you can pay us off. I've had some friends back home that played golf at Drake. So he was the number 1 golfer at Drake. Zach Johnson, that you guys heard of from Cedar Rapids, went Drake and won the Masters. He was like 2 and 3. These guys are best friends anyway. So Zach's from Cedar Rapids, Ben's from Carroll. Ben gets some investors from the country club back home, and they all throw like $4,000 or $5,000 in. Okay, and then they started a corporation, and Ben is then allowed to go play golf, and he pays his money out of this corporation. They invested in them. The contract stated they didn't want to make any money. Just if he ever made it big, they would get their money back, and he would pay them out of his winnings. Okay. And that's a corporate. I mean, so there's a variety of corporations. It doesn't just mean this, right? They started that corporation, and then, you just try to help people out, give them startup money so that they can go do their thing. But for our purposes, this company is going to do it every 3 months or quarterly, right? They'll be paid on the 15th of the following month. So how do they get declared? By the board of directors. They declare it one month, and on the 15th of the following month, they make it happen. So our transaction, 3 Greens board of directors declares a dividend quarterly of $0.05 per share. Capital stock issue to 75,000 shares for a total dividend of $3,750. Okay, date of payment is January 15th. So this is how you'd figure it out: 75,000 times $0.05, because that's how much you're going to be paid out. You debit dividends, and we're going to credit a company or account called dividends payable. Okay, the liability to paying the dividend. But this dividend debit will lower retained earnings. You guys understand that? Okay. Good. Dividends payable to show the increase in liability. I don't know if I showed you that, but that's just describing what we just talked about. All right. Dividends, again, is a temporary account. That'll be something you'll need to know. I highlighted that, but it's already been highlighted above. But just as a reminder, it's a temporary account. What do we do with temporary accounts? We close them. It'll be closing the retained earnings later on in the book. Okay. Declaring dividends. We issue one check to declare the dividend. Okay. We send it up, we set it out, and then the payroll will pay it out. Paid quarterly dividends, paid cash for quarterly dividends declared on December 15th, 3,750. You notice that the dividend was declared in December. The following 15th of the month, we pay it off. Okay. When we pay the dividends, we debit the payable to get rid of that liability that we incurred when we declared it. You declare it one day, debit dividends, credit dividends payable. When we pay it, we get rid of this payable, and then we credit cash. You can see here, every time you pay it, it just keeps going back and forth. You declare it one month, pay it the next. Declare it on June, pay it in July. Declare it in September, pay in October. Declare it December, pay in January. Okay, every 3 months, you got to go through it. The entries posted dividends payable account, so it makes it 0. And they talk about the steps here. And that should be it for that section.